Hello, welcome everyone. This is John Person for our monthly and quarterly seasonal outlook. The most important thing before we begin, if you would just take a moment to read the risk disclosure statement and remember that trading involves risk of loss and that this presentation is educational in nature. The whole point of trying to do a quarterly and monthly outlook, we generally try to say what's going on. This is the midpoint of the year where we, in order to figure out where we're going to go, we kind of start to look at where we've come from. The overall stock market tends to see strong and weak periods throughout the year. We've had a very strong year, that's for sure. So how is the time period that generally, when the summer comes upon us, which we have now, typically October through April are the best performing months overall through the history of the market. And of course, dynamics have changed. This year, we have certainly a few variables that have changed. A new, not just elected party is what I was trying to say here in the United States, but also globally. There's this push for nationalism across the globe between, of course, Frexit and Brexit, meaning France and England trying to maybe break off from the European Union. A lot of that has to do with, it's all about money, of course, right? So with the debt that's ensued with some of the lower GDP countries or sub-GDP countries that they're footing the bill for, people are, countries and citizens are tired. So there's been a big change across the globe. So then there's also another monumental change with monetary policy. We see the Federal Reserve, the European Central Banks tightening, or at least here in the U.S., we've raised interest rates 3 times, and we are seeing the European Central Banks saying we're reducing the need for quantitative easing, and they've gone from a easing monetary policy to now a stall, and then the next phase would be tightening. So there is changes of fiscal and monetary, and when changes come, things get readjusted. So for the equity markets this year, the weakest period begins in May and ends in October. So let's take a look at some charts real quick, and then we'll get into some strategies. First and foremost, we have the S&P 500 in our current time frame in the market. Typically, as we head into the 4th of July, we see a little correction. We go up into maybe earnings, and then seasonally speaking, the S&P 500, its worst time period is in this quarter. Now, are we going to map out the market just like that? I mean, go straight down? And the answer is probably not. And one of the things that I always like to teach our students, and whenever I give presentations, is if you're going to respect or use seasonal analysis, the first thing that you do, which basically takes an average of prices over time. So we take a line chart of multiple years and average together, and that's how we get a picture of what the average trend of the market is. A lot of dynamics have changed on 100 years. A lot of dynamics have changed in 20 years. A lot of dynamics have changed in 8 months, right? So with that said, can we trust the seasonal tendency of the market? Well, if a market has been in sync with its seasonal tendencies, I kind of respect and have to look at the seasonal trend of the market, but I use technical analysis to help me, and we'll get into that in just a minute. Next, let's look at a few other markets of interest. Gold. Gold tends to have a decline, which it is right now doing. It has a tendency of declining going into July, and of course, as we get into July and the 4th quarter, this quarter is one of the best times for gold prices. Now, some people do not like to trade gold futures. I respect that. And a lot of people trade the exchange-traded funds, whether it's GLD or IAU. Now, I think I should mention where gold miners, junior miners, the GDX. Now, GLD is the ETF on gold futures, so to speak. GDX is the gold miners. Gold and GLD can rise, whereas the miners might not move or have a delayed reaction. They actually start to move up in late July, early August. So there's a lag time between a move up in GLD and GDX. So if you're going to be trading and watching these two or this segment of the market, keep in mind that GLD moves first and there's a lag in GDX. I thought I'd point that out to you. Next, I know many of you probably might not be interested in trading some of the commodity markets. However, what I would point out is that there's this really dynamic commodity play if we get into a lull period in the markets. And the reason I bring this chart to focus is that cattle prices have been declining this past quarter, in the second quarter. But as we get into the third quarter, this isn't a seasonal low, it's an annual low. One of the best times of the year to actually look at buying live cattle futures is in this time period. So I know that a lot of people probably are laughing right now saying there ain't no way I'm buying live cattle, but this does have a strong seasonal tendency to see some upside moves. All right, let's get back to other commodities. Crude oil. Now, crude oil traditionally, this is a market where an example is, has crude oil gone up and respected its seasonal tendency so far? The answer is no, it has not. So therefore, it traditionally goes down after it's rallied. So the question begs, can we trust seasonal analysis on the energy complex, specifically crude oil this year? And I don't think so. So I just wanted to point out, here's a prime example where typically we see a very strong period of time for crude oil, and then it weakens throughout the quarter. This year may be different. We might not see as much decline in its seasonal weak period, so I'm not looking for crude oil per se to have a tremendously strong period, and I'm not looking for it to have a tremendously weak price action into the next quarter. So that means option traders, XOP, OIH, some of those integrated like your Phillips 66, your Valero, some of those type of stocks will probably not see a strong advance, and they most likely won't see any type of strong decline from here into this time period. So that would be an option writing strategist's iron condors would come to mind with the right metrics of using your options Greeks. So with that said, I just wanted to point out to you, there is a way to use the seasonal analysis and apply it to individual stocks. This next chart's interesting because things have dynamically changed. In fact, we started teaching this. This is an old chart from way back when. As you can see, not much has changed in the seasonalities, but technology tends to, in June, and this year's a little bit, it has started to see some peaking in names like Apple. We'll go through that. And so the internet index, which has changed, but looking at technology stocks, we definitely see a time period where if they're after strong uptrends from the first two quarters, we see weakness going in to the middle of the third quarter. So this is actually something that is working. We put that on our checklist and watch for continued weakness in that sector. So we would be looking at not just Apple or internet stocks, the what would normally be called FANG stocks, Facebook, Netflix, Amazon, Apple, Google, for example, or Alphabet now as it's called. But a lot of the technology names also, another sub-component that I want to talk about, weakens this time of year and has already started to weaken. In fact, let's get in on that. That one sector is called semiconductors. It's had an incredible run this year. We've been in a sell signal. We actually peaked out in the beginning, the first week of June, with that shooting star pattern. And many of you, if you're using Thinkorswim or have my TradeStation package, you would note that that is a PPS sell signal. We've been in a weekly sell mode now for several weeks. Some of you did sign up and took advantage of getting the person's market catcher indicator. It is a relative strength indicator which gives us a guide to the market's mean for conditions of performance of an individual sector to the overall stock market. And I'll share with you right now what that is. All right, the four main components is a market outperforms the market, and we get bright blue with a green moving average. The market starts to lag the market, but still is strong, and it's dark blue. The market starts to weaken against the market and is a lagging condition, and it turns red. And then when the market starts to improve, which obviously it hasn't, but what I would point out to you is this is a daily chart on the semiconductors, and when we made that strong reversal, you will note, if I can draw a straight line, we were starting to see the market lose its relative strength against the overall market, and it is still negative, plus we saw a decline in volume. So this was not giving us strong buy signals. In fact, the semis is one of the things that we've been talking about, at least in our community, with Lam Research, LRCX. Let's look at that real quick, LRCX. In fact, we wrote an article about Lam Research and to put on 150, 145 bear put spreads a while back, and many of you, if you are on my email list, maybe you had read that article. So LRCX, let's take a look at Lam Research. Ironically, look at the relative strength versus the market, and this is a special indicator. It's a volume indicator, folks, and this is exclusively available on our TradeStation package. But this actually measures the rate of change on volume trends in terms of percent rather than individual pricing structure. This is the relative strength, and one of the things that we look for are divergences, and Lam Research makes a newer high. And let me bring this into focus a little bit better for you. So clearly you see the primary high and a secondary high. So if this is peak number 1 and this is peak number 2, the corresponding peak number 1, peak number 2, with that little bearish divergence. So this is not something that has been in our catalog of wanting to buy. In fact, what we are looking at is a sector rotation coming out of some technology, and I believe we're going to just start to see what we've been seeing all year, a sector rotation. A lot of the institutions getting out of certain areas, they get into something that's underperforming, and they just go back and forth, and that's what we've been seeing all year. Case in point, remember biotech. Biotech, all of a sudden we've got the semis going down, and you got the biotech that went up based on the healthcare changes. XRT, and if you take a look at XRT, all of a sudden, as we've got some technology names have done what? Gone down because of the internet space, as well as the semis see seasonal weakness. This is a space in the XRT that actually starts to get a lift. You know, people go on vacation, they go out to the Cape, they go to the Hamptons, maybe they come here to South Florida in the summertime, maybe they go in the Caribbean, St. Thomas, hotter than the Dickens, but boy, I'll tell you what, Joost Van Dyke, there's a wonderful bar down there called the Soggy Dollar Bar, many in the British Virgin Islands. A lot of people flock down there, not necessarily maybe in front of a hurricane, but I'm just saying wherever you go on vacation, you are dishing out the do-re-mi. If you have grandchildren or children and they go to Disneyland, it's not that cheap, so you're dishing out money. Consumer spending, need new flip-flops, need sunscreen, need new shirts, need new, hopefully, Under Armour. We'll get to that in just a minute. Maybe Nike, maybe the kids are going back to school. Soccer camp, tennis camp, golf camp for dad, maybe. But with that said, there is some spending that takes over. Here's the interesting component. The XRT actually does see a little seasonal upturn this time of year, and this has been one that has just been given no attention to in the last 6 months. And everyone knows that retail has just been beaten up. No one's going to malls. And the funny thing is, Amazon is buying brick and mortar company. They're leaving the kind of business model. Amazon was what? Internet based. Now they're building more warehouses. That's kind of a brick and mortar type of situation. And now they've just acquired Whole Foods. That's a brick and mortar grocery store. So with that said, I don't buy the story that malls are dead, people are only shopping online. People probably just weren't shopping because of economic uncertainty, as well as times when you get a gross domestic product economic number of sub 1.5, you're not having a lot of high paying jobs, number one, even though employment's quote unquote full. What we are seeing is more service menial jobs, and yet it's really not been something that we've been seeing consumers feel comfortable spending a lot of money. But this time of the year, in the summertime, we do see an uptick. Now, let's take a look at the condition of the market as it's gone down in the XRT. We've noticed that my volume indicator, as prices have gone down, it's actually made higher highs. It's actually showing bullish convergence. Now, the relative strength, as you can see right here, it was starting to make a newer high from point number 1 to point number 2. What did it do? Point number 1, point number 2. It diverged, and then it went negative. So the PPS sell signal got fired off or triggered right here, and we had a weakening volume condition, and we had a weakening relative strength condition against the overall market. In fact, it lines up about there. So when it starts to fire off negative, the trend moves down. Now, you don't really want to look at this until we start to see a relative strength improving, and that's the fuchsia colors and a white moving average. So when you start to see the fuchsia and a white moving average, it means that there is some accumulation coming into the market, and when it fires off and we get positive relative strength versus the overall market, you might get a launch to the upside. We're in that condition right now, so what I'm seeing is a sector rotation grind out of some of the heavy technology names, the semiconductors, and into some of the retail apparel stuff. Here, let's also take a look at energy. Nobody wants to be in energy, but I believe we are starting to see, as you can tell, a bullish convergence, and look at the relative strength indicator. We're starting to see improved relative strength for the overall market on an uptick in volume, and we got a PPS buy signal. Those are positive. At least we have small defined risk. Now, XOP, we could see rotation out of some equities, sectors that are overvalued, and into some sectors that during the driving season, if someone drives to the Grand Canyon or drives to wherever they drive on vacation, or increased fuel consumption from traveling for the holidays, maybe perhaps we see an uptick for a slight trade in the energy component sector. All right, that sector rotation has been taking effect, and we are seeing it, and I'll share some more stocks with you and why these indicators are so powerful. Let me also show you and go back and talk about live cattle, because live cattle, and I know that I'm just using this as a case in point with seasonality. If a market's gone down in its seasonally weak period of time and it starts to show promise and move up, now this is not an indicator we want to use, live cattle versus the S&P 500, so it's not going to be efficient, but we definitely have a PPS buy signal in cattle. We're at person's monthly pivot support. The month's ending, but we will see if maybe perhaps cattle's just in a slight trading range, right? And it may see some upside. By the way, cattle from every dollar move from $100 to 105 is a 5-cent move. That's $400 per cent, or dollar in this case. So that would be a $2,000 move. So if cattle goes from, let's say, 116 up to around the 130 handle, that's a 14-cent move. 14 times $400. That's a $5,600 move to the upside. And as you can see, we already are in a daily buy mode. And so therefore, we want to see if there's an uptick in volume as we get through the 4th of July and as people consume maybe more hot dogs, but also cattle prices, people start to prepare to do what? schools back to lunch as you get into July and August. The next thing you know, September's here. So we look for a fattening of beef, and we also have a lot of summer heat stress on cattle. We may see ranchers lose their herd a bit, and so that is a couple of the reasons. But most importantly, we may also see some export demand pick up with a weak U.S. dollar. Gosh forbid we do a trade deal with China and lock in some beef sales. That would be very good. And the seasonality this year may fire off to be a very dynamic trade in live cattle. Now, let's take a look at some of the more widely held popular stocks in that technology area. As you can see, we had a PPS sell signal right here in Apple. And the momentum of the market was going down. The relative strength versus the S&P was going down. And as the market made a newer high, what happened? The momentum of volume is moving lower. So now we are in a negative volume pattern with a negative price pattern. And we may see more further price erosion out of Apple. So that money coming out of Apple may find its way in some other sectors in the market. Let's take a look at a few more. AMZN. I just mentioned Amazon because I know a lot of people really appreciate Amazon and what they do and how we use their product. But quite frankly, we did have a miniature flash crash for back, if you recall, and we saw that market move down to that 940.38 handle, something of that nature, in just minutes. But I'm looking at this market as the momentum's declined. The relative strength had slight divergence, meaning it made newer highs, but the relative strength has not. And this again is a weekly chart on Amazon. To me, I would suggest that we see a move back into the 9, testing that flash crash low as we get into the next quarter. And again, what happens in the next quarter is the first thing that happens in July and into August is earnings. So earnings will play. It depends on how much decline we get ahead of earnings, but I would have to say that that will be an important area to hold for Amazon, but we should see some follow-through weakness to retest that low level that we saw on that flash crash low. Let's take a look at another one that everyone's more than likely using, and of course it is Facebook. Facebook, when I look at these numbers and I see a market that has made an enormous stride to the upside, from point A to point B, I like to look at the momentum and the relative strength. And as you can see, the relative strength is weakening and is the volume. So we're missing something here. It's called a PPS sell arrow. So we don't have that yet in Facebook. But based on this condition and that light volume, if we do get a sell signal, it would be more than likely we come back and test into the 140 or lower level for Facebook. Why do I trust those two indicators? Let's take a look at IBM. When Warren Buffett was making his announcement that they reduced their holdings in IBM by a 30% stake. I don't know if you guys remember that, but Warren let everybody know that right about there. And he said they sold right about there in the 180 area. Well, ironically, you can see that we got a PPS sell signal. The momentum was going down, the relative strength was weakening, and the volume was declining. So let's take a look at a daily chart now, and this may show a little bit better of why we look for these highs and these divergence patterns on these indicators. So if Warren was getting out near the 180 area, let's take a look together. So that left us up in that zone. The volume was starting to show divergence. The price made newer high, and yet the relative strength started to go down well before the price peaked out, right? So Warren was probably, this light volume rally was him selling a 30% stake of IBM. And that's why we stay focused on the not just relative strength, but the volume, the condition of the stocks, and how and why we look for things. Many of you get my Twitter or follow me on Twitter. And you may note that a lot of times I put out some important information. One was this particular situation on Chipotle Mexican Grill. And if you look at the dynamics of the structure of my proprietary indicators here with the relative strength person's market catcher, as well as the volume indicator, you'll notice that it's a very similar pattern, but just a different time frame. IBM had that pattern back in March, and Chipotle Mexican Grill had that pattern started in late May, early June. So we identified this as a selling opportunity, actually had it in our weekly thoughts and observations. And what was really interesting is that this market formed a PPS and a low close doji at the highs on a what? Bearish divergence volume and weakening relative strength. Now, Celgene, CELG. Celgene is kind of interesting because it, before everyone was even talking about getting into the long side of the biotechs, note what we were looking at as far as the structural change. The relative strength was improving, and that's the fuchsia. Weakening red, improving fuchsia, outperforming blue. Those are the three areas. Dark blue is lagging. So those are the four conditions that we identify with this relative strength indicator. All right. Next, look at the volume. Market started to make newer lows. The volume started to show accumulation, for gosh sake. So it was starting to already show some insiders buying the market ahead of time. In fact, let me change this over to a weekly chart, because in our June 5th issue, our scans had picked up a weekly high close doji pattern on Celgene. And there is the weekly high close doji pattern with improved relative strength and improved volume. And so we had information ahead of time of some of the biotechs. All right, so just to let you know, I'm going to share this with you. Here is the June 5th issue, and just as you know, with Word document, many people, you may realize that the last time this was created was June 4th, which is a Sunday. I send this out to our clients and they get it, and therefore are prepared for the week. All right, so if we scroll down and we give a listing of what we are talking about. And by the way, I want to go over this chart with you guys today. We've been talking about this chart and that objective in the market for quite some time. So I wanted to share that with you in just a minute. And we have options that we're looking at, of course, and different trade setups and different things that we put out and performance. And now we can go right back into, here we go, bullish weekly high close doji signals. Biogen, Celgene, CVS, JB Hunt, Haynes brand. Those are some pretty powerful setups for clients to take an idea on the market, and that's why we give out that information every week. All right, gang. So we're talking about seasonality, and we're talking about what do we do in July and what do we do in the second quarter. And here I am talking about different indicators and sell-offs and things that did happen. Well, we're also sharing with you that this is a market that is privy and prone to sector rotational changes. Now, this particular chart, I'm going to explain this real quick. This is something that is an 11-week cycle. The 11-week cycle is something I wrote about back in 2002. It was published in the Futures magazine, which in the day back in 2002 was the top publication for trading. Between Stocks and Commodity magazine and Futures magazine, it was the thing to be writing or be asked to have an article in. And the 11-week cycle has not a lot of interaction with Fibonacci except for one. 11 weeks, there's 5 trading days in every week. Times 11 is what? 55. All right, so 55 is actually a Fibonacci recurring number, meaning if you add 0 and 1 and then you add 1 and 1, you get 2. If you add 2 and 1, you get 3. If you add 3 and 2, you get 5, and et cetera, all the way to 55, a reoccurring series number. Anyway, the 11-week cycle was something that back in 9/11, September of 9/11, interacted with an 11-week cycle high, and the market went down that week. It was really eerie, and it just goes on and on. The long-term capital management, something I had identified, and it may have some interaction with maybe a 50-day moving average. It just seems that there's something there. Now, cycles, just like anything, are not 100%, but they are good futuristic identifications of when a market after a rally could peak out. We've had several different corrections off of 11-week cycles. Now, sometimes they work, and sometimes they're lagged, and sometimes they don't work at all, or they work a little bit. We call them muted events. Sometimes they work dynamically great. Sometimes they just cause a market to stall. Sometimes they just cause a market to stall. Sometimes a market to stall, a little correction. And this one had a small correction, nothing happened. And the next one is due on the end of July, around July 26. Now, this is just a simple channel trend line, green for support, red for resistance. So I wanted to bring this to your attention because this is, as I shared with you, something that we are looking at and been looking at for a while, is that the potential for the market to go up into testing that level. That would be a person's pivot quarterly resistance up there. That would be also an area of rate of measurement extreme up in that zone. And boy, that would be about a 4% move higher from last Friday's close. Now, this is an indicator down here called the McClellan oscillator. If you're not familiar with this, this is an oscillator that deals with the breadth of the market, which means the advancers versus decliners over a period of time. There's a moving average component, just to make things simple, right? The McClellan oscillator has frustrated a lot of people because it's not it's considered a leading, and it may be too leading, but it is considered a leading indicator in the sense that when it gets near overbought conditions, it warns us of sell markets impending corrections, okay? If we get a zero line cross, it also can be an illustration that the market can go down. Now, we also have divergence patterns over a period of time. If this market makes newer highs and this indicator can't, it will also illustrate markets selling off. We have had an enormous upside in the market, and the McClellan oscillator is forming a really massive divergence formation. It is my contention either we get up into that red zone of resistance or we're forming divergence right now, but the timing element, it's just saying if we get up here by that 11-week cycle, and if we have confirming evidence of a divergence, then we may be at an impasse ready for a pullback in the market of a pretty sizable move. What would that be? Well, let's face it, if the market gets up into that 2,500 area and we pull back to the green line of support, it would be a 6% correction. So, okay, but it would also mean that the market went approximately from December, it was up 13%. So still positive on the year. It just means that you want to stop buying the market as we get up there, and we may see a more deeper, meaningful correction, a broad-based correction in the market, rather than a sector rotation correction in the market. And it seems right now, friends, we are getting a sector rotation correction. We get out of technology, they go into energy. We get out of semiconductors and they go into healthcare, biotech, right? So we get out of industrials and we go into materials. We get into housing, we get out of housing. I mean, that's the rotation that we're talking about. And every different stock index, by the way, has a weighting differential, meaning different sectors weigh on different indexes. Let's take a look. All right, this is the S&P 500. So we have the S&P 500 broad-based 500 stocks. This is the Dow Jones Industrial. Every single Dow stock is in the S&P 500. Next, this is the NASDAQ 100, heavily weighted towards Biotech companies like Celgene, also technology names like Google and Apple, and some of the internet, the software application stocks, which has had a tremendous run this year. And I'm talking about Autodesk, I'm talking about Vigo, Broadcom, and Broadcom being a chip maker, and I'm talking about Adobe. So between the semis and those software applications, it's really weighed on the NASDAQ 100. And then there's the NYSE, the New York Stock Exchange, a broad-based index which the McClellan oscillator is based off of, right? Now, what's wrong with this thing? This NYSE hasn't broken out, not doing a lot. It has a strong weighting with both healthcare, financials, and retail stocks, and drumroll, energy. Same thing with the Russell. Russell, small cap regional banks, small cap energy companies, small cap everything, right? So that's been the kind of like the laggards. The funny thing is if you take a look at the performance of the breadth of the market in this index, the NYSE, it's trending higher, and this thing's trending lower, and the breadth is moving sideways to down, and so is the volume. So we have seen a shedding of positions in the NASDAQ in the Qs. Some of those technology stocks are in the S&P 500, and yet that's why we have a difference of percent changes year to date, such as at one point the NASDAQ 100 up almost 22%, and the NYSE barely up 6%. I mean, what a difference between these indices. It used to be that, you know, a broad-based rally meant all the stocks would go up together, and, you know, things would be sort of friendly on the playground. But when you look at a difference between the NASDAQ up almost 22%, the S&P up like maybe 9%, and the Dow only up also 9%, you know, there was too much money that went student body left in technology. And so no one wanted to put any money into work in retail stocks or in energy. And so that may change, especially as policies being dictated from Washington. There was a big concern that there would be a taxation and this and the border tax. And so that really was what accelerated that the student body left into technology. And as you all know, man can't live with Facebook alone. Women, children, but man, not necessarily. Fishing, golf, things of that nature we need. And that requires sports stores. So let's look at sports stores. I hope you found humor in that. I was just trying to say that here is Under Armour. Now, this is the voting right UAA Under Armour. You could also look at UA. But we have an improving momentum. We have the relative strength going from weakening to improving. And there's a little better volume going on. Now, that's a weekly chart, so let's take a look at a daily chart real quick. Now, the daily chart has started to see the relative strength versus the S&P 500 got a lot better. The volume looks improved, and we have a small uptrend in the market. Now, we have earnings coming out in the month of July. So there's a lot going on that's going to dynamically change and perhaps how traders see this market. Is this an area where we would likely see rotation maybe come out of some of the technology and maybe bank on some of the consumers buying their product? Well, you know, I will say Jordan Spieth, who's a golfer dressed head to toe in Under Armour, won a tournament with an amazing chip out of the bunker in a playoff. And I mean, they were showing Under Armour for quite some time. But in any event, I think that it's got a lot more to do with that marketing as much as it has to do with the company's bottom line and exposure. And so while we haven't seen huge strides or follow through in this as we get into this summer, this may be the time that we start to see that basing action, especially as the volume and the relative strength starts to improve. Okay? Now, let's take a look at Nike and say, well, what does that kind of look like? And it doesn't look great, but it has improved. In other words, Nike's outlook, we have relative strength improvement, we have a volume improvement, and again, it's in a sector that nobody wants to be in. But I think that Nike has the ability to maybe maintain structural strength above 50, and we should see some upside after maybe its earnings reporting and take us up into, testing up to the 56 level. Other stocks in this space, Lululemon, by the way, breaking out. But look what started the breakout. It started not just in one day, but the accumulation started, right, as the relative strength started to improve and the volume analysis started to improve, and Lululemon caught the market by surprise. So there is some strength in some of these areas. Next, let's look at PSX, Phillips 66. Nobody wants to be in energy, but yet Phillips 66 is seeing upside volume action as well as relative strength, and is both of these looking positive. Kind of like the opposite of Chipotle Mexican Grill, the opposite of Apple, opposite of everything else we've been sharing that's gone down. So some sectors and stocks are going down. This sector is starting to get a little bit more respect in that regards. All right, now when we get back this weekend, we have a 4th of July that takes place on Tuesdays, the holiday. So the Tuesday, the markets are closed. So we've got the government that could, may, or may not vote on health care and pass that legislation. We don't know. But next Friday, as soon as we get back from the 4th of July, remember, Wednesday, we're all going to be groggy. We've seen the fireworks. Our heads are going to be ringing. It'll be a slow day because it traditionally is. Because, God forbid someone has one too many Budweisers or their favorite Corona for Constellation brand, which they've been selling a lot of. Stock symbol STZ had amazing earnings, so it had a big, huge spike. But keep in mind, Friday we have the unemployment report, and then Tuesday, July 18th, buckle down the hatches, baby, put your seatbelt on. Earnings season is upon us, and that ought to be interesting. On Tuesday, July 18th, we've got Johnson & Johnson, IBM, Goldman Sachs, Bank of America, and Lam Research. Then in July, we have the FOMC, and we have the ever-present Congress and any potential fiscal policies that may come out of the White House. I strongly recommend you go to this website. It's thehouse.gov, and you can get a clean slate of a calendar of events of what's going to come out of Congress before they convene for their summertime vacation. It might give you a better idea, so you're not caught blindsided by the news report. I don't know if you've been trading in the markets and all of a sudden you're doing markets and it just moves and CNBC's got a commercial and you don't know what's going on, or Bloomberg. And in this day and age, we need the media on because tweets come from the president, things happen in Capitol Hill that we need to be aware of. So with that said, this is the direct source, so you're not caught blindsided. Be prepared, be a Boy Scout, be prepared of what's coming down the pike, and that's a great start to look at the website and the calendar of events, and that's why I wanted to bring that to your attention. All right, let's talk about the month of August and the next quarter and new developments and things that are going on here, right? It is an algorithmic traded world. There's no doubt about it. Now, many of you had gotten some email invitations. We had a mentoring class on algorithm. It's going to be here a whole week in my office, and that's completely sold out. And all it basically is going to be about is how we take specific trade setups. Now, many of you are familiar with Thinkorswim's product, their platform, and of course TradeStation, and you look at the PPS sell signals. Now, these are dynamic buy and sell signals. Do we take all of them? No. Now, listen carefully. For those in the audience or those watching that are PUG members. PUG members. PUG stands for Persons User Group for TradeStation Users. Okay? This is a new tool that you guys will be getting. Basically, what this is a multiple time frame. I've had it forever. We forgot kind of about it. It didn't seem as relevant, but combined with our algorithmic trading setups, it kind of helps us to say when the dominant trend is in a sell mode. And then because of the computer programming and things of that nature, we improved on this indicator dramatically. It's pretty cool. I'll define exactly what I'm talking about. So this generates only sell or buy signals that go, if this is a 5-minute time frame, which it is, it will generate a sell signal when the 15-minute is in a sell mode. So while it was in a green time frame buy mode, you notice that at this point in time it generated a sell signal because the other time frames were in a sell mode, and it went with the dominant trend. And then it has an algorithmic feature to have a stop loss as well as a profit target. So this is all done automatically. Now, why didn't it go long? Let's take a look at this real quick. Now, here is something from a discretionary standpoint where the market makes newer lows, the volume made higher low. This was giving us an idea, and so possibly, yeah, you could get out at a better price, and I get that. But nothing is perfect, and you're not going to buy the low, and you're not going to sell the high. But the moral of the story is it's not going to take a long position in the market because the time frames are off. So they're, it's not 100% perfect. So a discretionary trader may say, well, gee, the volume's improving, we got bullish convergence, and maybe I want to take a bullish setup. Well, when you get a bullish setup and you get a buy signal, the algorithm will go in. If you'll notice here, we'll go over even looking at the prior day. Now, you notice there's no trades in the overnight session because we've disabled that feature. But when what's really neat is that, let's say you want a swing trade, and you have you change this from a 5-minute to a 60-minute. So this is a 5-minute chart, and what it's showing you is that the 15-minute, the 60-minute, and the daily is in a buy mode. So when all the time frames of my PPS indicator, it's based on that thing. This is very powerful. It means that you're taking short-term signals with a dominant trend. It's kind of like what we have in our scanning feature, scan number 1, which means show me a daily buy that's in a weekly buy mode, right? Multiple time frame like signals going with the dominant trend. So it is going to generate a buy signal when all the markets are in a buy mode, okay? And if you'll notice, this is another algorithmic feature. It generates, and I got the wrong drawing tool. It generates It generates a buy, and it gets out of half the position and gets out of the other half on a scale out. It trails by these little last conditional change candles. And it'll not take a short position, even though there's a sell signal, because the dominant time frames are green. They're bullish. So it'll take a buy signal right here and get out of the trade. Okay? So this is a very neat feature to help discretionary, self-directed traders stick with the dominant trend and to filter out and to trust better signals. That's what I wanted to share with you guys. Now, let's face it, in the last couple days, it's been kind of a wacky market, right? So how is this helpful for a trader? So let's take a look. First and foremost, it's profitable, so we got that going for us. Number one, how is the percent profitable? Well, quite frankly, it's ironic that it is on the short trades, and this is just from the last couple days. So I just wanted to share with you this week. This is a 5-minute chart, so it's taking 5-minute trades, right? So for the last week, this is a good sample because this has been a goofy week. This is probably abnormal, but this is 80%. You improve the odds. But here's the real killer right here. You've got to have winning trades greater than losing trades. Now, I'm not saying every trade, you can see that not every trade is going to be a winner. You're going to have losing trades. Everyone needs to recognize that. As far as what kind of an account size required. I mean, no one's going to day trade with $225. There's not enough data here over the long haul. But what we wanted to just bring to your attention is if we combine the short-term signals with the higher degree time frame signals, how will that work for us? And obviously, it improves our profitability, and all we need to learn is that algorithmic scale-out function. So let's take a look at what these functions and features are real quick. So just go over here. We're going to look at this. Now, this is not available for the public, but the first thing that we want to do is when do we want to trade the system, right? So that's the first thing. We only want to take signals in that area. Say you want to change that to overnight and you want to change it at 3 in the morning. Great. What about position calculation method? If you'll see here, we're on changing that $1,800 profit is just trading 2 lots so that we could scale out of one and get out of the other. So it's only doing 2 lots. So if we change that to where we want to maybe give a position risk of $1,000 per every time we trade, let's take a look at that real quick. So I'm just going to change that to position calc method 2. That gives me, this is position calculation 1, this is 2, that's 3. So we're on position calculation method number 2. Let's hit OK and see what happens. All right, so what it does is it automatically changes our contract sizes, right? That's all it really does, right? So what do? We take it up from an $1,800 to a $3,600, doubles the amount of money. And so that's another feature that we're trying to help to develop for the individual trader, and part of algorithmic trading is to create these things. So this is really exciting for the end user, and yet this is not available. So what we are doing is just helping to teach people how to encompass this. So very least, PUG members, I don't want to whet your appetite and steal your fun. What you will be getting, by the way, we're doing a PUG group webinar next week, Wednesday, when we get back, right after the, I don't know what I was thinking after the 4th of July. We're going to talk about that individual tool that all VIP PUG members will be receiving. It's an additional feature. So if you, what's really neat about that is if I change that 5-minute chart to a 15, then this automatically filters and increases the next time frame. If I change this to a 1 minute, that will decrease this, automatically changing. Quite the smart, savvy tools that we all expect when we are looking for trading tools in this new millennium. Well, I hope you guys enjoyed what we were talking about. I wanted to make this fun, engaging, also exciting, and let you know what is out there. And if you're like me, that sometimes you walk away from the market at the precise moment things move, if you trust a system that has dynamic performance stop loss, then that's algorithmic trading, and we need that. If you want more information on what we do around here at Person's Planet and what events that we're coming up with, may I let you know of announcing a very few presentations that I'll be doing this year. In fact, the mentoring sold out. We do have a waiting list. We haven't scheduled a second mentoring class where you come to my office and we develop this type of programming together for individuals for a whole week. You sit down with me. But we're doing a 3-day seminar, and it's in Palm Beach, Florida. And the agenda is going to be algo trading for stock, ETF, and futures traders. The platforms we're going to be using include Thinkorswim, TradeStation, and you're going to learn applications to apply to other platforms. So if you traded other companies, that's great. You're going to walk away with knowledge. Go to personsplanet.com, algo-trading.html for more information and sign up, because this is going to be a very important and powerful seminar that everyone, if you're a serious trader, needs to attend, especially in this environment. For ETF traders, let's take a look at something that's the most dynamic product right now, or has been an intriguing product. It's the VXX. It's the volatility index. Now, on Thursday, we had a little bit of a pullback in the market, let's say. We did 158 million volume when the average volume during the month has been 67. That is enormous. Compare that to the XLF or even the spiders, the S&P 500, the spiders, the ETF, the Qs, 74 million. I mean, great volume, but that VXX. So if you've ever heard anyone talking about volatility and hedge funds in volatility products, and they're not trading options maybe to hedge their portfolios, they're more than likely talking about the VXX. So we have a VXX trade product, and that on the signals. And so I don't want to go into it today, but what I will share with you is it's a very serious, based on our signals, a very serious product that has a decent performance. In fact, if we take a look at the performance since inception of 2009, it's a pretty straight up arrow, couple drawdowns here and there, but it's a very volatile product. So with that said, when we take a look at trying to help people trade in the markets and systematically in an algo trading world, those types of returns are based on, even in this case, a very small menial $13,000 account. Well, we all know you can't trade $13,000 accounts in equities. You need a minimum of $25,000, but this product is not day trade. It holds positions overnight. And this is part of what we're going to be talking about on our seminar. So once again, everyone, go to personsplanet.com, personsplanet.com, number one. Number two, go to events and click on the link for events, Seminar in Florida. Seminar in Florida, right there. And you can read all about what we're going to be doing. It's going to be an enormously successful event. We want you there. If you feel that you need improvement and want to get in on trading algorithmic signals and stay disciplined and focused, this seminar is for you. Regardless of whether you day trade futures or stocks, this is the seminar to be at this year. I'm excited to launch this and to share this with the world, and I want you to be a part of my community of successful traders. Thank you all very much, and I hope you enjoyed today's presentation as well as what's happening here at Persons Planet. Take care and have a great and safe 4th of July weekend, everyone.